Welcome to one more episode in the valuation course. In this episode, let us look after few fundamental concepts and foundation concepts that are required to understand the valuation and importance of valuation. First, let us talk about value and valuation. The term value refers to number assigned for any item or for any product or for anything. So, what does we understand by value? Monetary value or monetary number or monetary consideration assigned to an item. Since we are in the beginning stages of valuation, I just don't want to spoil the theme, but just for our understanding, the whole valuation of our course is related to valuation of business or valuation of shares. So here, instead of item, we can call it as assigned to the enterprise or entity or enterprise. So in our entire course, we will look for valuation of the entity and or valuation of the enterprise or valuation of the shares, or we can also call it as valuation of securities. Okay, now we understand what is value. Value refers to a monetary number or a consideration that is assigned to share or the business or the entity or the enterprise. Now, what is valuation? This is the process of identifying and assigning value to the business. So the process of identifying and assigning value. So to whom the value is assigned, either it is to the entity or it is to the enterprise or it is to the equity shares, etc. So let us understand the next very important concept called as premise of valuation, or just to understand the definition or the context of the premise. Premise refers to the assumption or presumption. Okay, so what is a premise? Premise is a basic presumption or fundamental assumption. While doing valuation, that is the process of identifying and assigning the value, we should have a fundamental principle or we should have a fundamental assumption and presumption. This can be either two ways. This premise of valuation can be two. First one is going concern entity, and the second one is liquidation. Going concern entity refers to, okay, let me put it this way. All entities will do business assuming that the business will not stop and the business will keep on running for the foreseeable future. If that is not the case and the business is not working out well, so the business will be closed or business will be stopped. The process of closing or stopping the business is called as liquidation officially, or also we can call that as winding up. So when we are assigning value to the entity or when we are assigning value to the shares, we should have the premise. What premise it can be? First premise can be assuming the business is a going concern for the foreseeable future. The second premise can be assuming the business in the is to be liquidated. So both cannot exist in the same scenario. Any one of the premises can be existing for the valuation. So both of them cannot be existing. Going concern refers to for the foreseeable future. Business will go on. Liquidation refers to business is not working out well and this is going to be shut down. So that is the basic assumption of the valuation. Any one of that should be there. Next, let us look for why valuation. Why should we value the business? So there are primarily three purposes for the valuing of business. First one is sale. When you want to sell the business, you will value. Second one is for taxation purposes. Sometimes for taxing the business entity, we will value. And third, for liquidation. So now let us again come to the scenarios here. When you are selling the business, you can sell the business as going concern and you are valuing the business to sell the business to other person to keep it running. This is what we call as mergers and acquisitions. So someone will acquire and merge the business entity into their business, and in some cases for the purpose of taxation we will value the businesses. Very recently Income Tax 2025 Act has came into the picture. Earlier there used to be a Rule 11 UA valuation, which is valuing the equity shares. So for all the tax authorities, they will value the shares and they will value the businesses in order to arrive at the consideration, and they will think for under consideration and over consideration of the share price, and then they will charge it. So you might have already heard about something called as angel tax. This is for angel investors, which is the taxation of under consideration of the shares. We will talk more in detail about this concept in a later period of times, but just for our understanding, what we have to know is, based on taxation law, whatever we arrive is called as legal value, or you can call that as fair value as per law. If any investor has acquired a share for the price less than such legal value or for the price less than such fair value as per law, then that is called as under consideration. Price is less than legal value. In such cases, the gap between the consideration and the legal value will be taxed. So we will talk more in detail about this. Just for our understanding, the purpose of valuation shall be taxing the sale proceeds also, or taxing the consideration in that case. So during liquidation, the business will be valued and the business will be wind up and shut down by selling all the assets, by realizing all the assets, by payoff of the all creditors of the businesses. So during liquidation, why we are valuing? To realize the assets and to pay off the liabilities. So for these purposes we will do the valuation. Okay, now let us look after the undervaluation and overvaluation. See, undervaluation and overvaluation is very relative concepts. Let us say, in the previous session we have understood about fair value. Fair value is the value that is agreed between a knowledgeable buyer and a knowledgeable seller. Let us say if the asset is valued lower than that fair value is called as undervalued. So lower than fair value. Overvalued refers to higher than fair value. I am just giving you a reference benchmark, like if you take certain value and if the business value is less than that value, then it is undervalued. If you take certain value and if the business value is more than such value, it will be overvalued. Usually, very usually, we will see undervaluation in the kinds of motor vehicles. Like motor vehicles are generally valued less than their intrinsic or fair value, and real estate assets are valued usually more than their fair value or intrinsic assets. So that's the undervaluation and overvaluation concept. So let us talk about a few other things. There is something called as valuation standards. These valuation standards are issued by IBBI board and they are freely available in ivsc.org. So this valuation standards have a detailed analysis or a detailed formulations with related to valuing the business. So globally, multiple countries have come together to standardize these procedures, and that's why there is a huge importance for valuation standards. I'll take one full session for the valuation standards itself to give you a brief understanding of how those valuation standards are defined and what are all these things. So as of now, this is the part of our session, but the next few 4 minutes, let us talk about few things which are not related to our course, but just they are related to practical world scenario. First one is, let us understand valuation engagements. And let us understand valuation process, and let us understand valuation documentation, and we have to understand finally valuation report. So these 4 all related to practical world scenarios. Valuation engagement refers to the assignment which is taken up by a valuer from the business to value the business. So primarily, whenever you are having a valuation engagement, we would recommend to have valuation engagement letter, and the letter shall have a clear confidentiality clause which is refers to non-disclosure. So engagement letter shall have confidentiality clause, and it shall have clear scope defined. So what is the scope of the work, how we should arrive, etc. should be there. And it should have indemnity clause. What is an indemnity? If there is a loss, then we have to compensate. Maybe loss caused by the business or maybe loss caused by the valuer himself. So in both the cases, there should be there. And there should be clear purpose indicated. So why this is undertaken, maybe for obtaining the outside capital, maybe for going to the IPO, or maybe for debt. What is the clear purpose of this valuation should be there, and there should be any other terms that are relevant for the engagement, and there should also be kept for the disclaimer in the engagement letter. This is a standard disclaimer usually, because valuation is generally applicable to a specific set of assumptions. If any one of the assumptions is deviated, then the valuation may not be valid. So all those things shall be clearly mentioned in this engagement letter. So next, let us talk about valuation process. Valuation process is not that simple, but however, whenever there is a valuation taking place, it's simple only, but not simple. So you should plan the assignment. Once it is planned, then we should gather the information. Information is of two types. One is internal to the business, second one is external to the business. External information shall be taken from the reliable sources. Example, SEBI, National Stock Exchange, and Bombay Stock Exchange, or any other regulators like Ministry of Corporate Affairs or somewhere, but those sources should be very reliable. The internal sources of information shall be documented and kept separately. So here comes the third point, which is called as valuation document. There are two valuation documents, which is internal and external. Internal is provided by the business users, example employees, CFO, CEO, or any other business people which are inside the organization or inside the entity itself. So the external valuation documentation refers to from a trusted and reliable sources like regulators, primarily SEBI, RBI, ROC. So these people have so much of information about the organizations outside our businesses. So maybe about industry standards, maybe about how the industry operates. So all those information should be trusted and reliable sources only. We should not assume anything here. Yes. Next, after gathering the information, we should clearly document the purpose. So ideally we should say document all the sources, purpose of valuation, and we have to establish a clear premise. Why? whether it is a going concern or whether it is about to be liquidated. So we have to clearly set and establish the premise and clearly identify all the stakeholders who will use this report or who are involved, and document all the findings. Whatever findings have taken place during the process shall be documented, and we will have a first stage report. After first stage report is there, then we should evaluate the secondary evidences, that means external sources, and we should evaluate external sources, and we should prepare the draft report. When draft report is there, then we can go for accuracy and finalization. Finalization and accuracy. So now we have seen how the valuation engagement shall be undertaken, like we should have a clear engagement letter, and how the valuation process will take place, and what is a valuation document and what kind of valuation document is there. Now let us look after valuation report and its contents. So the valuation report is the final report kept or issued by the valuer, and it is very professional. It should be very professional, like we shouldn't give any kind of dirt or unuseful information in the valuation report. So what are the contents of valuation report? As we already know, there are few contents that you already can identify. So the valuation report content shall contain primarily executive summary, which means about the business, about the top level management, about all that kind of a bird's eye view into the business organization is called as executive summary. And we shall clearly mention the assumptions of this valuation, and also we should clearly mention if any one of these assumptions is not valid, then the valuation report doesn't stand still. So that's a disclaimer we should always mention. Of course it will come in the later point of time in the valuation report, but just I'm saying the assumptions shall be clearly mentioned. And what is the expected deliverable delivered through this report? Expected deliverables, and whatever is delivered through this report shall be written. And most important one is valuation date, on what date the valuation is taken place. It should clearly mention valuation date and report date. Let us say I am valuing the shares on 31st March 2026. I am preparing the report on today, that is today's date is 5th of April 2026. So I should clearly mention the valuation date as 31st of March and report date as 5th of April. Clear? Right. And we should clearly document the source of data. I mean to say internal as well as external. Both the sources we have to mention. And we should clearly mention the approaches of valuation, or we can say techniques of valuation that are used. There are various approaches and techniques, which is primarily cost approach, income approach, market approach, technique refers to discounted cash flow technique, or future yield technique, or super profits capitalization method, or another capitalization method, whatever method we have used or whatever technique we have used. So those approaches and techniques shall be clearly mentioned. Approaches, techniques and methods shall be clearly defined and mentioned in this. And not but not the least, whatever kind of estimates or whatever kind of projections that are used shall be clearly mentioned. Estimates and projections shall be clearly specified in the report. And finally, disclaimer. As two special points for the disclaimer is who will use this report, and if any one of the assumptions above is not valid, then the report doesn't stand still. So these are the 8 important contents that a valuation report shall contain. Okay, but these are not just the exhaustive list. There are various other things also. Especially we have to look for Indian Standards of Valuation 2017. In that they have specifically mentioned what are the contents that are required to be kept in the valuation report. The list is not exhaustive. If you want to add other headings, if you want to add other information, let us say market analysis, let us say future outlook of the industry, let us say anything report that is that you have referred to and you have your valuation has changed, so your significant opinion is there, so all those things shall be there. Okay, these are the additional concepts that I just wanted to explain to you as a practical real world scenarios. Thank you for watching, and I'll keep myself upgraded, and I'll keep all the content keep coming on a daily basis or on a weekly basis. Whenever time permits, I'll keep posting all the information. If you find this information is valuable, please give a like. If you think someone out there needs to see this video, share the video with them, and please subscribe to the channel. That gives more encouragement to do more and more videos, and keep notification bell active so that you will get notifications for all the contents that I am posting. Thank you. Jai Hind.